My name is Bronson Hill. I'm the CEO of Bronson Equity. We've got about 200 million in multifamily assets. We're also doing things like oil and gas deals, ATM machines, and car washes. Love talking about all things multifamily, all things real estate. There's a lot to talk about here, and we have some heavy hitters on the call today. So super excited about this. Just going to give a quick introduction. We've got Ryan Gibson, who's coming in from Seattle with Spartan Investment Group, works in self-storage. Welcome, Ryan.
Thanks, Bronson.
Awesome. We have Bob Fraser with Aspen Funds out of Kansas City. Welcome, Bob.
Great to be here.
Good to have you. And we got Ashley Wilson from Bar Down Investments.
Thank you so much for having me.
Awesome. Great to have all you guys. So all you guys are our friends and peers, done deals with some of you guys. And so it's really exciting to have you in the room. And I think these panels are incredibly powerful because we can get a greater perspective than what we have just from one of us. And all of you have YouTube and podcasts and shows and Instagram and all the things that you're doing. But it's amazing we get some great minds in the room to have a conversation about what's happening. And gosh, isn't there a lot to talk about these days, right? There's a lot going on. Rates the last 18 months have risen. They're continuing to rise, and that has an effect on real estate. Maybe someone wants to start us out. Maybe we'll have Bob start us out. Can you kind of set the table for us a little bit? What are you seeing right now, and what has shifted in the way that you approach real estate?
Well, fewer deals are passing muster and penciling, as you might imagine. And credit has become more of a focus than in the past. Typically we had 5 lenders lining up for every deal. It's much thinner. So a lot of bankers are telling us we're pausing right now. So we're making sure we're getting everything lined up before we're bringing deals to the bankers. Make sure we can really get the deal done with the bankers, and they're far less. Interest rates are one thing, but they're really less willing to go deep on LTV. Into higher LTVs, those kind of things. So I think that's probably the biggest change, and it's fewer deals are penciling, but there's still a lot of deals that do pencil. So
yeah, that's true. And lending is a huge change to the atmosphere and what's happened. Fewer lenders wanting the business, because every month that goes by, the Fed raises rates. If somebody lends now versus lending in a few months, they will have lost money, or at least not got the return they would have got if they waited. So Ashley, what are you seeing in the market? I know you've done a lot in multifamily. You mentioned about development. Talk to us a little bit about what you're seeing, and also kind of how that's shifted how you're approaching the real estate market.
Yeah, so because I'm hyper focused on multifamily, I'm seeing a lot of different things. So from one perspective, we're also seeing exactly what Bob just mentioned about fewer deals are penciling, but it's also a combination of fewer deals are actually even being presented because there was such a high volume of transactions in Q1 and Q2 of 2022. So in terms of debt that was placed at that time, it doesn't make sense for anyone to sell at this point. Most people opted for long-term stabilized debt. So there's high prepayment penalties associated with exiting those deals so early, coupled with the fact that there's a massive discount on what people paid for those properties in Q1 of 2022 and Q2 of 2022. So you're not seeing as many deals cross our desk just because there are less deals to be had. I have started to see several investors have some urgency to sell, and that is because the deals that are available are typically ones that didn't sell in 2022, which means that they were most often originated under floating rate debt. And the issue with floating rate debt is not the debt in and of itself, which has its own complexities, but also the rate cap accrual. So rate cap accrual is crushing cash flow for a lot of folks, and they don't have enough reserves to carry the property because the rate cap accrual that the lenders are asking for is just astronomical. I will tell one personal story. Our property was accruing approximately $303 a month when we first acquired it in September of 2020. And to date, we are now accruing $74,000 a month just on our rate cap that we are paying into the lender, from $303 to $74,000. So if you didn't have the foresight or just the operational wherewithal to understand what was going on in the market, and you didn't put aside reserves, you could be in a really precarious situation. And that's definitely something that we're seeing in the multifamily market. And then obviously the same thing with respect to where lenders are willing to place capital. So a lot of markets have now become pre-review markets. So that has put some additional challenges on getting these deals done.
Yeah, absolutely. No, that's a huge part of lending too, with those rate caps, going up to 10, 20, 30x or higher on the cost of those. Really exceptional, particularly in multifamily. Ryan, talk to us. You're in a different space. You're in self-storage. Can you talk to us a little bit about self-storage, how that's changed or is changing, how lending is affecting that market, and kind of what you're seeing right now?
Yeah, just carrying on the conversation about rates, asset management and debt capital placement has become like the two most important people or departments within your business. And, I don't think that's anything different than self-storage. We have taken on fixed rate debt on all of our assets except one portfolio. And obviously that has been challenging in our grand scheme of things. But self-storage has, we're selling a lot of assets right now, and we're seeing, we're still getting a high 4 handle, low 5 handle on cap rates on some of our dispositions. So we're seeing the asset values hold strong, which doesn't play favorable for buying property right now, because if you're paying in the 5% cap rate range on an asset with interest rates in the 6s, the 7s, maybe even the 8s, we have this new era of negative leverage. And so we have the challenge of, lenders not really having an appetite for lending in a negative leverage environment like that. So I think we see a lot of the challenges that other asset class spaces change. Couple that with that, the industry is up on record highs as far as occupancy and rates. And so we're seeing a cooling right now of kind of going back to pre-pandemic rents. We're seeing a historical amount of move-outs in the space. So we're actually seeing a little bit of softening in self-storage in general overall. But we're still seeing the assets trade remarkably well, perform really well, and we're not seeing the cap rates slide per se, but it's far from over. And, I think with interest rates so high, it's only a matter of time before those start to soften, across all of real estate, if they haven't already, in your specific asset class.
Question. Thanks for sharing that. I think we are seeing softening all over. Does anybody know, particularly in your asset, whether it's self-storage or multifamily, what percentage of loans are bridge debt? I've heard some figures as high as 80% or 85%. I've heard them say it's more like 50-50. Does anybody have any opinions on what that is? Because obviously the higher that number is, the more potential distress there could be with, $100 billion, I think, alone of multifamily debt that needs to be rolled over or refinanced every year. Does anybody know how much that is, either in self-storage or multifamily?
I do not, but I know that Yardi I think it was their Q1 report, did quote the percentage of properties that are under floating rate debt. I don't know if that's available I'm pretty sure that's available to the general public on their site. If you go to I'm pretty sure it was their Q1 update, they did a breakdown of how many properties originated under floating rate debt or were carrying floating rate debt, but I do not remember the figure.
No worries. It's definitely a factor everybody's looking at. Now, I know before we started, as we were kind of getting ready, I know Bob and Ashley were talking about this. I know Ryan, you're involved in this as well. But there is a renewed interest in development, which I think initially can sound a little counterintuitive. Because you say, well, if things are getting harder to finance or if things are getting harder to sell, like why would developing sometimes actually make more sense right now than going after something existing? Hey, Bob, do you want to start with that one?
Oh, okay.
Or Ryan, either way. Yeah, go
No,
ahead,
Bob,
Ryan.
you got it.
Yeah, we started moving into development a year and a half ago, and find that in industrial, which we love, the cap rates were far too low to get in, and there was nothing available, and huge demand. I mean, just the vacancy rates are at all-time record lows really across the United States. And so really was a great development play. If you can find good construction crews and to keep your costs down. And basically we're developing industrial around $65 a foot, all in, including land. And it's worth about $130 a foot when we're done. And it's a 9-month build. So we find that's pretty compelling, number. So, and we're doing multifamily development now as well, just starting some deals in there. And we can build, again, costs are all over the map depending on where you are. But a lot of deals are penciling right now in development, where they're not in purchase of these assets. So as Ryan pointed out, the cap rates have not really risen very much. So it makes buying not that great. So the biggest challenge in development is just finding lenders with the appetite. And the other thing about development, you don't necessarily need a lot of leverage. You don't need super high leverage, and you're not holding the asset for that long doing development. So the interest rates don't really come into play as heavily. So yeah, I find development very favorable right now. I think we've seen the you've talked about an inverted yield curve. I think we're seeing an inverted risk curve right now, where it's less risky to develop than it is to purchase existing assets.
Yeah, I will passionately agree with Bob. When you think about buying a institutional quality self-storage facility right now, you're going to pay 5.5, 6 cap. And, you're going to have to get leverage on that. And that's going to be 6.5, 7% leverage, interest rate, negative leverage. Like we talked about, your equity yield might be 0.5%. It's going to be super low. So when you think about yield on cost, like that is really important to know what that is, right? Your yield on cost. When you take all the costs that Bob described, your cost to build, your cost for land, your holding and carrying costs, any soft costs, entitlements, development costs, and you add all that together and you apply that against the NOI of the stabilized asset. So maybe that's year 3 when you have it all leased up, and you divide those two numbers together, you get basically a cap rate, which is your yield on cost. So if you're getting, we're seeing anywhere from 9 to as high as 11.5% yield on cost in our self-storage developments. And we're building across 7 states right now. So when you think about, you want to go in at 11 cap, you're not, yeah, sure, you can find that in a junk market with, a low quality asset. Sure, you can find that all day. But if you want to build an institutional quality, good market property like industrial or self-storage, you can find these opportunities in markets that are underserved still, and go in at a yield on cost at 11%. And, that is where it's at. And yeah, I get it. The cash flow is not there. Development is inherently risky. So you just have to work through how the operator has mitigated their development risks and how much experience they have. And like Bob was saying, their construction process and who they've got dialed in. But if you're really, truly an investor and you're sitting on the sidelines right now, you're kind of speculating, right, where things will go. I think if you want to continue to invest and be a true full investor, ground up development is highly beneficial to, especially an operator that has experience doing it, or some kind of vertical integration, or some kind of partnership with a really sound contractor. You can make good money on that. And we don't know where interest rates are going to go, but if they do end up going down, now you're going to have an asset that's brand new, great, and you can refinance it, or like Bob was saying, you can flip it at grand opening or certificate of occupancy to some shops that are hungry to buy it. The trick is financing it. Just as Bob pointed out, that's why I think asset management and capital placement or capital advisory right now is the number 1 and number 2 thing that are most important things in your real estate shops right now. So
absolutely, thanks, Ryan. Ashley, anything you want to add to the development conversation here?
Yeah, I mean, I think Ryan started to allude to what I was going to mention, which is with respect to interest rates. So within multifamily development, the runway is typically around 24 months. I know, with industrial and self-storage, you have a shorter runway. So the exposure on the interest rate side when you're in a construction loan isn't as risky as it is in multifamily. But in multifamily, it's a pretty long runway in terms of how long you're carrying variable debt until you can refi into fixed rate. I think we can safely say that we're near, if not at the, hopefully coming to the end of these interest rate hikes and the volatility within the debt markets. So in terms of certainty, when you're underwriting your projections on the interest rate during the course of the build, and while you're, getting the property leased up, I think you have some more certainty. And then to Ryan's point, which is with respect to when you're projecting out your exit cap, it's all tied into the interest rate and the interest rate environment. So just looking at the cycles that we've had within interest rates historically, I think it's safe to say that within 2 years, 3 years time, the interest rate should be coming down a bit. Hopefully, once again, I don't have a crystal ball, but in terms of them being able to capitalize, with a new build product and be able to exit, I think is a great play right now. I also think in terms of just the fundamentals of how people are successful by investing off of market cycles, we're all pretty confident on where we are within the market cycle right now. And there are certain strategies that have just been tried and true on what type of actions you should be taking right now when you are in a recession heading towards recovery. I think a lot of people have been scared off thinking that there's an overdevelopment of multifamily, but I'm a firm believer that we don't have an oversupply coming. In fact, I think we have the opposite coming. I think there were a lot of permits pulled, which is where the data is being, looked at to project that we have all this inventory coming online. But I can tell you that that is not the case. Most of these projects aren't being finished, and it's because they can't afford the debt. So these projects have either been put on hold or fire sold. And to that effect, these projects aren't going to be coming online when they have been slotted to come online. So I think there's a lot of opportunity still within development of multifamily. And one last point I would just like to add is that we saw this, when you got into the compressed cap rate environment in 2022, which was, if you can buy a B class at the same cap rate or close to an A class, why would you not just go for the A class, right? And I think the same argument can be made now in terms of development. Why would you buy something today that you could actually have a greater return and a greater yield in 2 years by being able to control and develop new product?
It's great. I think too, yeah, you talk about market cycles. It seems like, looking back, you can see exactly, 2008, 2009, there was a window where it's like, this was the perfect time to buy. And it's that moment of kind of maximum pessimism is where it's actually the best time to invest, where investors maybe less likely, or maybe I don't know how you guys are finding it, but finding it a little more difficult to raise money than it was 12 months or 24 months ago. But can you guys talk about investor sentiment, kind of what you're seeing from investors, and maybe some of the conversations you're having with investors around this? Are you finding people are saying, hey, I'm gonna try to kind of wait and do a timing thing, or things are going to come down or it's going to change? Maybe Bob, you can just talk maybe a little bit about investor sentiment and what you're seeing these days.
Right. Well, yeah, I mean, we're definitely seeing investors, tightening all the sphincters down and, wanting to hold cash. On the other hand, we just did our biggest raise ever in the shortest amount of time, with our oil and gas. So I think investors realize that they're in extraordinary times and there are things that are going to do super well. And I was really surprised last year. We did a couple of local retail deals, neighborhood retail, which we're just super bullish about at a 9.5 cap rate, and these things are just cash cows, 100% occupied, and we couldn't get investors interested. So it doesn't make any sense to me because everything is saying, retail spending is like going gangbusters, and these little retail centers are not, there's no e-commerce risk, for your dog groomer, your liquor store, right? And they're, so, all the fundamentals are great, the thesis is great, and investors just don't want anything to do with it. So, but then you look, we've had, investor appetite for industrial, we found very robust, oil and gas, very robust. Multifamily is softened unless there's a story behind it. That's our experience so far.
Yeah, that's kind of what we've seen too, is that multifamily soften a little bit, but some of these other things like oil and gas, ATM machines, car washes, stuff we're into, there seems to be renewed or interest in. There's particularly cash flowing things that you show cash flow pretty quickly.
There you go.
That's
right.
a big one. So because a lot of these multifamily things we had that were cash flowing great. I think Ashley was talking about this, that the cash flow has been pinched by the cost of the rate caps or because of other labor costs, insurance, these type of things, depending on what market you're in.
Right.
Ryan, talk to us a little bit. What are you seeing investor sentiment in your area, and how are you advising investors you're speaking with?
Yeah, so we're actually talking to, we're doing an institutional recap of our portfolio right now, about maybe a quarter of it. And the sentiment on the institutional side is typically foreign money would funnel into the United States real estate market through gateway cities, and 30 to 40% of their allocations were in office. So obviously that is gone because, when I say gateway cities, San Fran, New York, Chicago, LA, et cetera. So now the word is out that, they're not investing in those cities as much. And they're certainly not investing in office. So institutional capital is really getting disrupted and looking for other places for funding. They're looking for things like self-storage or office or industrial, other asset class types. I mean, multifamily has always been a main food group in what they invest in. But they're getting more open-minded to things and strategies in the United States and maybe going into different markets. On the investor side, we have 3 funds this year, a debt, income, and growth fund. By far, our most sold out fund has been our debt fund, where there's a guarantee of monthly payments of interest. And then our growth fund on the equity side has been wildly popular because of the things that we talked about earlier, which is yield on cost, and that being more lucrative than trying to find some asset that doesn't cash flow quite well because you've got compressed cap rates and high interest rates. And so with limited inventory that Ashley alluded to coming to the market, you have limited stuff to buy at compressed cap rates, and you have high interest. So it's hard to make something cash flow in that environment. But through the ground up development, we're seeing, outsized returns in that fund. And we're seeing at or greater investor interest in that fund as we've seen in the heydays of 2021, 2020 of capital raising. So I would really just say it's been strong, and I would say where we're getting the most headwinds is on the lending side. As Bob pointed out, a lot of banks are just being more selective. You'd have 4 or 5 options. We're having term sheets retraded and, credit committee, which has always been a thing, but it seems to be more prevalent now. And also with leverage being lower, naturally due to higher interest rates, you're having to equitize properties more than you typically had to in the past. So you're having to raise more money to do the same deal. So it is requiring more investor capital. So it definitely feels like more of a struggle, at the table.
Yeah, absolutely. It's more money to raise, harder to raise the money, and it costs more to get it done, and the returns are lower. Who wants to sign up, right?
Yeah.
In general, obviously there are exceptions. There are many exceptions.
I'll make one other point too. I mean, for the first time, in a very long time, I'm older than all you guys, but for the first time, since the 80s, bonds are actually attractive. I mean, which one of you ever bought a government bond? And they're actually, really nice interest rates right now. So we're actually seeing softness in demand for income products as well, where people are saying, yeah, why not take a AAA rated government bond? Do I really want that extra couple percent? So, the world's definitely changing.
That's a great point. That's a great point. Ashley, let's hear from you. What else are you want to add into what Ryan shared?
I just look at things in the same light as what has already been said. So I'm not going to echo those same points, but I will say one other aspect of how I analyze things is the psychology behind what's going on. And I think that a lot of investors and just human nature is impatience. So a lot of people are impatient. At the end of the day, there's a lot of capital that needs to find a home, and it can't sit on the sidelines for too long because obviously it's losing money, and any strong investor will tell you that you should be constantly having your money at work. So money sitting idle is not sustainable for anyone, for private equity firms, for investors. So I think, with respect to having heard Bob say that he just concluded one of the fastest raises, that actually doesn't surprise me. We've seen a huge uptick in our database of available capital to be deployed recently. I think a lot of people historically were sitting on the sidelines trying to see what was going on. And a lot of consumer sentiment is centered around the debt markets and how and what the Fed is doing. So I think, we can argue all day long about whether or not we're in a recession, but what's more important is whether or not people think we're in a recession, because they'll act as if we're in a recession, whether we're in a recession or not. So that, I think, ties very closely with investors wanting to place their capital and find a good home for it. And I think that's why we launched a pref fund this past year. That's something that happened previously during previous recessions. It became really popular to do that because it helps on the total capital stack. So you have the senior debt, you have the pref equity, and then you have common equity, and it fills that gap that we were all talking about because there's less leverage that the senior lender is willing to lend on because it's too risky within their portfolio. So that is something that is very attractive. I know, I don't know all the details of Ryan's debt fund, but we are finding that that's something that people really like because of just the security that is around it in terms of the monthly payments paid first after senior debt before common equity. It doesn't have the high upside, but it just has more reliability and lower risk. So I think getting creative on these deals, I know a lot of people are able to convince sellers to leave equity in on the deal more than I've ever heard before. That's another strategy too, in terms of just getting that capital stack down and getting it in a place where the cost of the capital is not dictating the purchase price too much. It actually works in favor of the seller if they can leave some equity in.
Yeah. So I want to shift gears for a minute here. Great conversation. Loving this. We are going to take questions in a few minutes. The Fed came out for June just recently and said, hey, get excited. Congratulations. We're at 3% inflation now. This is what the CPI is 3%. Now, things like shadow stats would say it's more like 10 or 12%. I know there's different opinions on what that is. And so, if you have 100K in the bank, a lot of investors, I know people on here have, 100,000, hundreds of thousands, even millions in the bank, just kind of sitting there. You can be losing money. And it comes down to a question of alternatives. Bob mentioned you can buy government bonds now, actually look pretty attractive. And of course, if you get something with a higher yield and rates do go down, well, then you've actually increased the value of those bonds just simply by writing that out. What are you seeing as far as, I guess two parts to this question. One is with investors having choices here, and obviously the confused mind, in my opinion, will just say to wait and I'm just going to wait and see how it goes. Or is this a good time to deploy it all? Kind of on the side of that, what do you think the Fed is going to do? Ashley, you mentioned that I think it could be the next 2-3 years to start lowering rates, hopefully much sooner. I'd love to hear Bob and Ryan's opinion. What are you thinking about rates and where they're going to go?
Well, all right, I'll jump in. If you actually read what Powell is saying, you read the words coming out of his lips, he is 110% committed to 2% target. And even his spontaneous speech, everything about it, reading between the lines, he believes he can get to 2% inflation. And that's with his preferred version of the PCE, which is much higher than the CPI right now. So if he really believes that, we are going to be in for some pain. So because according to my analysis, we're not going to be able to get down to 2% inflation anytime soon, and certainly not without a pretty rough recession. So I've been predicting for the last year. I said we're not going to have much of a recession, if any. And but I've also said that they can create a recession if they want to. I mean, it's really how hard they want to keep hitting this thing. So, reading the Fed is a loser's game. But everything I'm saying is they are going to keep pressing until they hit 2% target, and I don't believe that 2% target's attainable. So I think we're in for some pain.
So Bob, follow up to that. So obviously the Silicon Valley Bank, some of the banking stuff we've had, I think we've had over 300 banks fail this year, a lot of small and mid-sized banks. What's the point where we say, oh my gosh, there's hundreds of billions of dollars of multifamily stuff that's starting to collapse? Or, I mean, or look at the stuff what's happening in the office space as well. Does the government step in and help any of those deals? Or is there any sort of backup fund available? Or do you think it just kind of all?
Oh, no. Yeah. When something is systemically important, they'll back it up. If Bank of America was in trouble, they would step in. But no, there's not going to be, for a troubled bridge lender or something, they're going to watch them go down and say, okay, we're doing our job. So I don't think we should expect bailouts to happen.
Yeah, got it. Thanks, Brian.
I think it's important. You might think, well, I'm not in office and I'm not in this bridge floating dead, and I don't, these things don't apply to me. But all these things are super connected, especially the big banks. So if you think that just because you're not in a certain asset class, you're not going to be impacted by this eventually. I remember like when PPP came out, we were going for new construction loans, and like all the banks just disappeared overnight because everybody was putting out the PPP payroll fires at their local branch, and they were dealing with their hotel portfolios and their retail portfolios that were on fire, and they just didn't want to put out any more money. So something will break. I mean, if you think about these interest rate hikes that the Fed does, I mean, at this point, do they really matter? I mean, the 300-pound weight has been put on our chest, and it's heavy and it's crushing us, and we're running out of oxygen. So the question is like, how long is that weight going to sit on us and crush us? Adding another 5 pounds. I mean, it's a 300-pound weight. We can't freaking breathe. Something is going to break. Something is going to fail, and it's going to have an impact. And the question is what is it? Right. And so I think that's the thing that you got to think about is like, what lever, what trigger is going to impact you? And, having a bunch of vacant office space and a bunch of over leveraged, devaluing assets that the local and regional banks are holding notes on is a big freaking deal. And, think about the leverage that's been put out by all the major banks at lower interest rates. And now they have a higher cost of capital. And I mean, there's a storm brewing. I'm with Bob. I mean, this is not how it ends. I mean, something's going to break hard, and then the rates are going to drop like a rock. But what is that? When is it? When is it going to, what's going to actually ultimately be the thing that does it? And then they're going to have to panic drop the rates. I think that's kind of most likely scenario. But, another quarter point here and there. I mean, you've already hiked all the way to the top of the mountain. You're tired. What's another, 50 feet, right? So
Right.
We're at the highest interest rates in the last 22 years. We're at the steepest incline we've ever had. And I think it's important to look back in time. I mean, study history a little bit and look at how long were interest rates at their peak. And, Bob, you probably know this better than I do, but, interest rates at their peak were, they've only been, I think the longest time in history is maybe 2 years or 18 months. So I don't know, like what makes it drop, or why were they up for as long as they were? I think that's really the tail. And I think that's why, cap rates are great today. What are they going to be in the future? It really is going to depend on how long does this huge heavy weight lay on our chest of the economy, because that will start eventually devaluing real estate.
Yeah.
When the Fed started the rate hikes, they self-admittedly said that there's a lag time of 12 months. So we're not even really seeing the impact of what is going on today. And I completely agree with both Bob and Ryan here that I'm actually a firm believer that I think it's going to be a major break, and I think that they're going to have to readjust quite quickly. I mean, one of the things that we know, just looking, to Ryan's point, is, studying history, is unemployment doesn't start to tick up until after about 6 months after, the Fed is cutting. So if we're looking at historic data and trends, and I don't think the issue today, let me just back up for a second. I personally don't think the issue today is the actual interest rate itself. It's the time that it took for us to go from, that 3% interest rate to where we are at today. That's in such a short, truncated timeline to raise rates so quickly, I think is more of the issue than the interest rate itself. I actually don't think the interest rate itself overall is damaging on its own, but the timeline that it took to get us to where we're at today, and that continue, 300-pound chest analogy, weight that Ryan was stating with what's another 25 basis points, it will break. And I think the problem is that we're at the point of kind of no return. Like, the indicator was probably months ago, but we're already, up that mountain. So what do we do? And I personally think, we're coming into, we're well into Q3 now, right? And we're heading into Q4. And I think last year we had a huge spend, just a consumer spending environment because of all of these things like PPP and COVID assistance that were still circulating. Plus, you had a lot of people that still had money left over from stay-at-home orders and all of these commercial shutdowns that all of a sudden they had all this capital built up and people just spent everything because they weren't, a large majority of Americans just aren't savers. So they don't know how to save money, right? So I think the season that we're coming into, I think we're going to have a major issue on our hand because I think that we are stockpiling inventory as if this consumer spending is going to continue, but the funds aren't there. And I think people are going to start to feel that pressure, and they're going to get through the holiday season as best as they can. And then there's going to be a major fallout in January. That's what I personally believe. I think it trends well with historic data, even in strong economies. I mean, what is the lowest or highest delinquency of rent collection? It's January. It's always January. It's not December. It's January because everyone has spent all of this money during the holiday season and they can't pay their rent in January. We have the highest delinquency. We have the highest credit card debts right now. We are just going into the worst time of year in the worst condition, I think, if you look at where we're at with student loans coming back online. And then also you look at our credit card debt. It's astronomical. It's one of the highest it's ever been. So I just think there's a lot of issues that are not being accounted for that are going to create this perfect storm.
Let me make a couple comments, if I may. I said I didn't think we were going to have a recession for a while, or it was going to be a soft landing, which is what Goldman has been saying for a while. And that could definitely change. But the reason is record high consumer spending. I mean, consumers have gone on a rip. Record consumer savings, very low debt service, very strong job market, strong wealth effect, record real income, and sitting on record cash, $5 trillion in cash, $4 trillion more than historically. So the consumers are in really good shape. I'll make another point. Again, I've been through 4 cycles. Okay, well, personally watched 4 cycles. The one thing I can tell you about the next cycle is it will not be like the last one. Okay, that's the one thing I'm positive about. And the one thing everybody is sure is going to happen is whatever happened last time, that's what they're worried about this time. And that's the one thing that for sure will not happen. Every crash has been completely different than every other crash. So the 2008 crisis was a banking crisis. It was systemic, and had the Fed not stepped in, we would have been sitting on a greater depression. I mean, it was going to be really, really ugly because the financial plumbing system was failing. And when you look at the credit default swaps and the counterparties were going under. And so the Fed stepped in, and honestly, what they did was brilliant. This time is not like that. What we're seeing is, and I'm kind of a bank dork. Okay. Some people, watch movies and things. I study banks and a little bit of a bank dork. I apologize, but the banks were very highly leveraged back then. And today, most of the larger banks are very, very healthy. They have, very lots of equity. And they're not highly leveraged. Now there's the regionals and the mid-sized banks are the ones that are in trouble, and they're the ones that have taken down a lot of this debt. For example, the office buildings, and they're holding a lot of things that are going to be written down. So we might see bank failures. My guess is the Fed will do nothing about it. Then we'll see the regional bank failures, as long as the big boys are continuing to chomp down on all that and take it at a nice discount and make money. I think it's going to be fine. So I don't think we'll see bailouts, and what breaks. I don't know. I don't know how we get to high unemployment right now with the job shortage the way it is, the worker shortage the way it is. So what will break? It's so hard to say. It might be something overseas, something we're not even looking at. But
if I can add one thing about you were talking about the labor shortage. I think one of the things, just in terms of what I'm seeing, is we have one of the largest new generations that are not contributing to overall GDP. And what I mean by that is we have so many people that are looking for other ways to make money, whether they're social media influencers, or they're self-employed. They're trying to figure out their own path. They're not doing the traditional career that we have seen historically. And I think that's a variable that's impacting what we're seeing today as well. I mean, we have the lowest amount of people entering the trades. That's going to be a major issue. The lowest number of people entering farming, once again, another major issue. So if you look at all of the fundamentals, it's one of those things. I think we can all agree on what the variables are, but what is the variable that's going to have the biggest impact in the melting pot, right? What's going to be the one that just tips the scale? And we look back and say, oh, it was so obvious. I knew that was coming, because we all can agree on the variables. It's just which one is going to be the one that really kicks us over.
Yeah, that's great. We'll take a couple more questions. We want to actually take some questions from the audience. So if you have a question, you can put it in the Q&A or the chat section, and we'll get to it if we have time. Rule number one, Warren Buffett says, is to not lose money. I've heard Ken McElroy say that 2023 is the year of operations. And I'm always, as a passive investor, and then of course we have our funds that we operate, but always looking at, there's a huge distinction between operators that are solid operators and those that are kind of shaky. What would you say are some things that, if you're a passive investor, you should keep an eye on for your real estate investments, whether it's multifamily, self-storage, or other assets? I'll start with Ryan, maybe, because we've kind of been going around here.
Yeah, no problem. Yeah, so I would say over the last 2 years, it's all we've been focused on is beefing up our operations team. We just recruited the VP of Asset Management from Extra Space. We recruited our VP of Operations from Prologis and Simply Self Storage. And I think operations is everything right now. Operations and asset management, really, I mean, they kind of tie together in a lot of respects. And so when you're looking at operations, I mean, we're in a tough market right now. It's a higher cost of conversion for customers, higher move outs. There is more competition, and there's fewer retail dollars placing into at least our industry at the moment. So if you don't have a dialed in operations team that's aligned with your organization, I think it's highly critical to look at that. So what would I look for? I would look for the quality of the team. But I can't stress that enough. When you look at, who is actually manning the operation of your business, what is their experience? When we went out and recruited a president of our storage operations, we wanted somebody who had direct experience overseeing 100 self-storage facilities, and a leader that came from an actual REIT. So you want to make sure that this isn't someone's like first rodeo when they're going out and, I'll figure this out by going to a bunch of conferences and learning this on my own. You want to have somebody who's in your operations team or multiple people that make up that team who've had institutional quality experience running the operation. And I think it's paying dividends for us now as we enter a harder market to acquire customers.
That's great, Ryan. Thank you. Bob, what about operations? What are you seeing as critical for investors to keep an eye on?
Well, if you've already placed your capital, I mean, there's, I think it's more important to talk about where you want to place capital in the days to come. If it's already there, I think the most important factor in existing deals was the initial underwriting and including the debt stack. And I've always said that's what's going to make or break a deal. There's enough tailwind in every deal we've done because we did our underwriting so well that, even if our operations are not perfect, we're still going to do quite well. So I'm a believer in tight operations, but I'm also a believer in building enough margin that you can have a hiccup or two, and that it's not going to mess up your returns. So, we're definitely focused on execution, but really the main thing is get your underwriting right. And I've seen so many deals that were poorly underwritten and with their debt stacks were a bug looking for a windshield, and investors, they had no problem raising money, which I'm just like, good grief, people, look at the debt stack, and figure out that this is a problem, so really that's what people should do, is understand the underwriting and understanding the debt stack. And then, make sure they're credible operators and they know what they're doing.
Yeah. Thanks, Bob. Appreciate it. Ashley, what are you seeing as far as the operational tips or things that you're seeing good operators do versus poor operators?
Well, I'm actually known for operations. That's what I'm known for the most in this industry. So I've been saying for years now that operations are very important, but in down markets, they are the most important. And I think as an investor, you should always be looking for someone who is a team, a company, a person who is heavy on operations and not just in downturns, because I don't think people who all of a sudden decide to pivot and focus on operations in downturns, it's too late. They missed the boat. They should have been preparing prior to that. They should have been focusing on that. One of the things that I have talked to investors about is when you're asking for track records, when people are stating these incredible returns over the past few years, that doesn't really carry any weight for me as a passive investor, because I also passively invest. I actually ask for the original projections of that investment versus the actual outcome. And what I'm looking at is for whether or not the cap rate carried them out of that deal or their actual operations. To Bob's point, I do agree in having reserves. So that's one of the questions that I ask, and I have my own algorithm on what I believe is a comfortable amount of reserves that someone has allocated, not only for the operations, but also in terms of the capital expenditures, and then what they have as a company too. So whether or not they are just reserving capital for that individual project, whether they're willing to step in as a company to also provide support if it gets to a dire situation. But I'm a huge believer that you should be focused always on operations, because it's the one thing you can control. You can't control the market. You can't control the debt, right? You can control when you're going in and locking in the right and the appropriate debt, but really make sure that you educate yourself. To Bob's point, don't just throw money at a deal because your friend's throwing money at a deal. Really spend the time to vet the deal and make sure that it's the right fit for you.
Thanks, Ashley. That's great. Yeah, we actually had a deal we partnered on, and you did some incredible operations with that. The one in Amarillo we worked on together. So that was a well done
Thank
job
you.
there. Yeah, that was fun. Getting a few questions coming in here. There's a couple I'm going to kind of combine here about investor expectations or changed. So I guess kind of two in one here is, are you seeing I mean, obviously expectations are changed, but if there is some sort of situation 6 to 12 months down the road, there's, better opportunities, there's some sort of crisis, or, something changes from where we're at. Do you think investor sentiment will be, hey, we really want to invest and we should get into this stuff? Or I think that probably the people asking these are a little more on the capital side of trying to figure out what investor sentiment is going to be. But how do you even project that? I guess you don't know until you actually start raising the money. I guess that's what I've experienced. But are you expecting that if there is a distressed time or things, there's much more distress, that it will get harder to raise money, or will it get easier to raise money because the deals will look better? And somebody can just jump in.
Well, yeah, when we hit the pandemic, right, there was not a dollar being raised anywhere, right? Everybody's like, what's going to happen? So everybody just froze, but it didn't last that long. So certainly if the stuff hits the fan, we're going to see that. But I'm just saying, to Ashley's point, saying a lot of people are cashed up and looking to put their dollars to work. They just want to have confidence that those dollars are going to be well taken care of, and people are looking for growth. I mean,
yeah, wherever they can find it. Yeah, cash flow. I got it. Ryan, any thoughts you wanted to add?
Yeah, I mean, I think that inverted yield curve, you can park your money in a savings account and make a decent interest rate, and there's no risk to that. You could buy an existing property with a low cap rate and high leverage and not have that great a cash flow, quite frankly. So where do you put your money? You put your money in something. I think you got to be patient and know that maybe something with a higher yield on cost, ground up development as an example, would be a good place to park your cash, or find something unique in these niche strategies like that folks like Ashley and Bob have, right? Where you find a niche opportunity in a niche market with a niche connection, and you can make things work. I think that's the whole benefit of being a alternative investor in what we do in this small space as operators, right? We are in the local markets, making hand-to-hand contact with people that have these niche deals, and that's where we can beat, the market in the long run. So I think it provides a incredible opportunity for investors. And, just have to know that, you're in this for the long run. This might be a 5 to 7 year hold. And, but at the end of the day, I think fundamentally it's still a really good investment overall in real estate, and, hedges inflation's well. And over time it beats out the market.
Yeah, that's great, Ryan. Thanks. Ashley, anything you want to add?
I think they covered it.
Okay, got it. Awesome. I wanted to make a quick announcement. We are doing a summit coming up. I'm going to share my screen here for a minute, and then we're going to come back to this. This is the Advanced Real Estate Investing Summit in Los Angeles, California. It's a 1.5-day event. Myself and Stephanie Boldrini are hosting. Ken McElroy, Neil Bawa, and a whole bunch of other folks, Mark Moss, some other folks here in LA. I'm going to put some info in the chat on how to find out about that. And if you use the code SUMMIT20, you can save 20%. So I'm just going to put this in the chat. Okay. All right, there's this, and SUMMIT20 is the code. That's 20% off. So I put that right there. Check that out. We'd love to have you join us. We're starting to get filled up on that. Wanted to go around, just make sure that we have time for each person to just real quick talk about how people can reach out, how they can follow you. I think this has been an awesome panel, just super high level conversation. I just have tremendous respect for each of you guys for being here. So maybe let's start with Ryan. Just how can people follow what you're doing, hear about your deals, and also just track what you're doing there?
Yeah, you can hop on our newsletter. Spartan-investors.com is where you can get signed up. You can email me, Ryan, at Spartan-investors.com if you have any specific questions about that. I'm on LinkedIn quite a bit, and we also mail out a newsletter every month. So happy to share that with you guys.
Awesome. Thanks, Ryan. Appreciate that. Great having you here. And if you're ever in Seattle, he's a big Kraken fan as well, right? The Kraken, the Kraken or Kraken? How do you say?
Kraken.
Kraken. Okay, what's Kraken?
You better learn how to say that.
I learn how to say it. Yeah, I don't live in Seattle anymore. I guess obviously I left before they became a thing. So, all right, Bob. What about you? How can people follow what you're doing?
Yeah, I just put it in the chat there. AspenFunds.us is our website, and yeah, we also have a podcast called Invest Like a Billionaire. You can go to thebillionairepodcast.com, see what we're saying, and I do economic updates all the time. We're very much first of all, economically driven. We look first for what's going to work. There's always something that's working, right? There's always something that's not working. There's something that's working. We have to look at what is working, not just the guys that have a hammer and everything looks like a nail. So yeah, we do economic updates and then invest based on that.
Awesome. Thanks, Bob. Appreciate that. Check out his show, Invest Like a Billionaire, as well. Ashley, how can people follow you and follow what you're doing?
I'm on all socials at Bad Ash Investor. So it's BADASH Investor. And just because my husband always promotes me on his podcast, which is called Drunk Real Estate, I highly advise everyone to watch and subscribe on YouTube. It's a panel with my business partner, Jay Scott, Mauricio from Premier Law Group, and then AJ Osborne from Cedar Creek. So there is definitely a vibe similar to today's conversation, where it's just a diverse group of people talking real estate over a drink, and it's pretty funny. So you can check it out on YouTube.
One more thing too, if we're going to do the podcast thing,
Yeah.
if there's a pilot in the room, you know how you'll know? They'll tell you. So we started a passive income pilots podcast, me and Tate Duryea. So if you're a pilot out there and you want to tune in and hear from like Top Gun people and investors and stuff, we do a passive income pilots podcast. So
Awesome. Thank you, everybody. The summit is being held. The Advanced Real Estate Investing Summit is being held in Los Angeles, October 19th and 20th. It's going to be awesome. Oh, what hotel? Well, it's at the website, but it's the Sheraton Gateway, so you can fly right into LAX, and it's going to be awesome. So this will be available on a replay. We get this question a lot. It will be available on a replay. I do encourage you to reach out to each of these folks. They have awesome deals, great reputation in the industry. We will be doing another event toward the end of next month. I believe we have the date. It's going to be an economic panel. So we do panels like this. Going to be on August 30th, and we're going to have an economic panel about inflation and just what's happening in the economy. So check that out. And again, thank you to our panelists for being here. Thank you for our attendees for being here. You know, the best investment really you make is in your own education. And sometimes we can get to all the questions. We can't always get to all the questions, but that's why you need to follow these guys and get on their lists and track them. So thanks everybody for being here. Thanks to our panelists. We look forward to the next event, and everybody have a wonderful night. Thanks, guys.
Thank you.